Hello everyone. Today I'm going to be showing you an easy and effective long-term investing strategy. And before I begin, just know that nothing in this video is financial advice. So getting straight to it, what we'll be doing is building a portfolio with somewhere between an 80 to 20 or a 60 to 40 ratio of VU to QQQ. And this will be based off your own personal risk tolerance. So having higher amounts of QQQ will be higher risk, but you're likely to have higher returns, but also bigger drawdowns. And having more VU, the portfolio will be more stable, but possibly have lower returns. So VU is a market cap weighted ETF. It's similar to the S&P 500, and it gives you exposure to all the sectors in the stock market. And market cap weighted means that the most valuable companies get the most money allocated to them. QQQ is a similar ETF holding 101 companies that are mostly tech, healthcare, and consumer stocks. These companies are high flyers, they're highly favored by investors, and they have more growth potential. So the average returns on QQQ since 2011 are 20.66%, and the average returns on VU since 2011 are 14.72%. And I'm just picking this year to start because this is when VU was created. So what we're going to be doing is called dollar cost averaging. The goal is to invest an equal amount of money into the market on a consistent basis, whether it's every week, 2 weeks, or every month. And you should not really be concerned with the prices of the ETFs at the time. You must make this a priority and fit it into your budget. Think of it like a bill that you have to pay or a plant that you have to water. And also, if there is a big sell-off or a dip, like right now, you should consider adding more money at that time if you're able to. But the most important thing is being consistent. If you have a lot of money sitting around, you may want to consider lump sum investing and just depositing a lot of money and getting it invested in the market at once. This is especially true if you're young and have a lot of money sitting around. You do want to take greater care of lump sum investing if the market is overvalued or near all-time highs, because you don't want to get bagged, get down on your positions, and get discouraged. And also, if you are older, you should probably take greater care with lump sum investing too, if there's a possibility that you may need the money in a few years. So, if and only if you want to get more sophisticated with your investing, after you have, say, $1,000 or a few $1,000s invested, you can start adding a few individual stocks as well. But only keep it to companies that you like, you believe in, you use their products, you believe have capability and room for growth, and very importantly, has had a strong stock performance. Until you really know what you're doing, limit it to only a few companies and try to keep 80 to 90% of your overall portfolio in ETFs. The goal should be to never sell the ETFs unless you have to. Say if it's a big purchase like a house or an emergency, something like that. You don't want to get shaken out when there's a sell-off or sell them just because you think they went up too much. Trust me, I've made that mistake. You're aiming to build wealth safely over time. If you commit to dollar cost averaging into strong ETFs, you will outperform most investors, and you will also achieve far greater gains than bonds and saving accounts would ever net you. Thanks for watching. Please like, subscribe, and give me a comment if there's a certain topic you'd like me to cover.